Welcome to the essential guide for navigating this week's financial turbulence. The markets were rocked by unexpected news, threatening to derail the tech rally we've seen all year. Today, we're diving deep into the recent spike in market volatility. From central bank warnings to sudden tech stock crashes, understanding these forces is critical for every investor. It all started with a surprise hawkish warning from Federal Reserve Governor Lisa Cook, immediately followed by a sudden plunge in key tech stocks, most notably Nvidia. We need to analyze this cause and effect relationship. The goal of this video is simple: to give you a strategic, actionable playbook to protect your portfolio from a potential market correction. Stay tuned, because defense wins championships in investing. Let's first tackle the source of this market instability: Federal Reserve Governor Lisa Cook's unexpected and hawkish remarks about future interest rate hikes. Governor Cook signaled that the Fed might need to raise rates further and keep them elevated for longer than previously expected to truly tame inflation. This was a deviation from the recent dovish pivot narrative. This warning fundamentally altered market expectations regarding inflation and future monetary policy, driving up bond yields and increasing the cost of capital across the board. The immediate reaction was felt hardest in the technology sector, with market darling Nvidia leading a sharp, sudden pullback. We saw a significant sell-off in Nvidia and other high-flying tech names. This drop wasn't just profit-taking. It was a clear sign of how quickly market sentiment can change when interest rate fears resurface. High-growth tech stocks are highly sensitive to rising interest rates because their valuations rely heavily on future earnings projections. Higher rates drastically reduce the present value of those far-off profits. Now let's move into the action plan. Strategy 1 focuses on portfolio defense, building a fortress against market downturns. The first step is reducing overall risk exposure. This means taking profits on the riskiest parts of your portfolio and increasing your cash reserves for future buying opportunities. Cash is king in a correction. Shift your equity exposure toward defensive sectors. Utilities, consumer staples, and healthcare tend to hold up better because demand for their products remains relatively constant, regardless of the economy. Strategy 2 is all about smart diversification, ensuring your portfolio isn't overly concentrated in a single vulnerable area. If the recent market moves taught us anything, it's the danger of concentration. Diversification means moving beyond the crowded trade in U.S. large-cap technology. Consider adding value stocks, which are often priced lower relative to their earnings and are less sensitive to interest rate changes. Also, look into alternatives like real estate, commodities, or managed futures to spread risk further. Our final strategy focuses purely on risk management, setting controls to prevent small losses from becoming catastrophic. Implement stop-loss orders on your individual positions to automatically limit downside risk. Decide on your maximum acceptable loss before the market moves against you, and stick to it. Review your position sizing. No single position should be able to cripple your entire portfolio. For larger investors, utilize hedging strategies like index futures or options to explicitly mitigate systemic risk. We've covered the fundamental drivers of the current market anxiety and laid out a three-pronged strategy to protect your wealth. Now for the final takeaways. Remember, Governor Cook's warning signals a credible risk of higher rates, and tech stocks remain the most vulnerable segment due to valuation sensitivity. This requires action. The most successful investors are disciplined, especially during volatile periods. Use this playbook to maintain balance, manage your risk, and be prepared to take advantage of opportunities when the dust settles. Thanks for watching.